Commodities have been on a tear, specifically metals. Gold prices hitting a record high today, boosted by mounting geopolitical uncertainty, fueled by the death of Iran's president over the weekend. We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined by Phil Strebel, Blue Line Futures Chief Market Strategist, and Timna Tanners, Managing Director at Wolfe Research. Thank you both for being here. Phil, I'm going to start with you. It's not just gold, silver, copper. We are really seeing some pretty amazing increases in many of these metals. Does a lot of it have to, is it sort of the dual thing here of geopolitics and then AI that's helping fuel this?
Yeah, if you break it down into copper, when you trade commodities, it doesn't matter what it is. You really got to identify two characteristics when investing. It's a supply-demand imbalance and it's market momentum. You look at copper, for instance, you've got increased electrical power use because of the green energy revolution. You've also got rising demand from electric vehicles, and advancement of AI have also strained the outdated electrical grid. So the combination pushes demand for copper, silver, and other metallic metals higher for the first time in over a decade. And this comes at a time when increased regulation makes it harder for additional supplies of these metals to come to light and end up in the end user's hands. So it's just creating this global deficit right now. It's a perfect storm for commodities.
And Timna, you cover the miners. Can you give us an overview? And these are very different companies, depending on what's mined and scattered throughout the world, different geopolitical structures and things at play. What are factors that the miners are concerned with right now, and some of those that are translating into higher prices down the stream?
The amount of new copper mines starting up this year. There's we can rattle off a couple off the top of our heads. There's Quellaveco, QB2, there's Oyu Tolgoi, and Kamoa-Kakula. So there's quite a bit of copper coming on, and a lot of the new copper demand isn't going to hit the market till 2030, especially data centers, maybe a 1% to 3% global phenomenon over from 2020 to 2030. So there's nothing really very incrementally supporting this massive rally, aside from a small deficit in copper if you look at the data. However, there's nothing to get in the way of a good, don't let the facts get in the way of a good narrative here. The reality is this is really a squeeze that's happening in the financial community more than in the physical market. There's a lot of shorts that were squeezed in copper. It's quite a bit of analysis on that. And definitely, the phenomenon of Russian material not being able to be delivered to the U.S. is causing a physical squeeze. In terms of the miners, certainly they are enjoying these higher prices. It's hard to explain how sticky they'll really be from what we just described. There's the high-profile potential acquisition of Anglo by BHP that looks like it's hitting a wall here. But we aren't hearing a massive amount of M&A. Even though it is hard to build, it's also getting expensive to buy.
Well, and Phil, to circle it back to you, if indeed at least a substantial portion of the copper rally is a short squeeze, like if you're not an experienced trader, do you want to try and chase that? How much sustainability does that have?
Well, this is where you got to really put your thinking cap on. You've got to manage your risk. You've got to manage your position sizing. One of the more recent plays that we had recommended to our clients was a particular call spread, where it's a calculated risk trade, which has a favorable risk to reward ratio, but it also defined the risks involved. So when it comes to investing of any type, you always want to manage position sizing, making sure that it's risk capital that's involved. So if you were going to step into the market right now, on the copper market, you could take some of these calculated risk option plays, or you could look at the micro copper contract, which is only 2,500 pounds. So every penny move, say from something like $5 to 501, would be a $25 positive impact in your account, or a dip down to 499, a $25 negative impact.
Timna, let's stick with risk management here. So the approach that we would have with the futures market, and whether you're investing directly in the futures or an ETF, that's a little bit different than a stock play where you're investing with miners. How do you go about that? How do you advise clients the best way to approach?
We have coverage names that are a little more liquid, like Freeport. We have names with a nice dividend like Southern Copper, and then we cover tech resources, which we think has the most interesting combination of a little discounted valuation because it's a show me story and execution of their operational ramp up at QB2, and some more interesting growth. So in our view, if you can have copper exposure with copper growth, that's the way to go.
Tim, I want to turn to gold and silver a little bit more now too, because as you look at the miners, I mean, many of them do multiple different metals that they are mining, but I'm curious what you think about the trajectory for those metals and which miners might be best poised to take advantage.
Sure, we don't unfortunately cover precious. We do have exposure through Freeport where they do mine gold. Their Grasberg mine is the largest gold producer in the world, and it's a great byproduct credit benefit to them. It's an interesting market when you see geopolitical risk helping gold, but also copper at all-time highs. It's not usually, they usually go in different directions. So it's an incremental positive for sure for Freeport.
And Phil, talk to me, please, about some of the volatility that we've seen in the futures market this year. I was just looking at a heat map we have on the Wi-Fi Interactive, and cocoa is actually up the most this year. It's up 68%, although it's still down 30% from its highs. Just wondering how investors should consider some of the volatility embedded in these markets before rushing out and investing in a metal.
Yeah, this is where you got to weigh in as far as those mini and micro contracts, account size, and everything else. A lot of the volatility we've seen, is because of the rising geopolitical tensions. You've also seen increased consumer investments, and one of the largest speculative long positions that we've seen in the last 2 years in the gold market. So you get geopolitical events, things that happen over the weekend and things like that. You're going to see a lot of that volatility here because of the fact that people are so embedded in the market. They've got so much exposure there, and the more participants you have coming in there, it's like a river and they all rushes in one direction here at the moment. So you always got to keep your 1 foot out of the door here and be ready to, be the first person to leave. They always have an old saying in commodities, you want to arrive to the party late, but be the first person to leave.
I like that. Timna, I'm going to give you the last word here. Anything we didn't touch on in this discussion that you want to leave with viewers?
I think you can't ignore the 800-pound gorilla in the room, which is China. China accounts for 50% of all demand for commodities that we follow on the metal side. And I think that China's a big question mark. So clearly they're farther along in terms of EV adoption than we are here in the North American market. But, and so that's positive for transmission lines for copper demand. But on the flip side, their property sector is, I'd say, in very late innings of development. You've seen, months now of the completion side reversing, which is usually negative for copper. So are we seeing net copper demand in China or not? I think a lot of that will depend on how these stimulus measures play out. And so far, they've not been that impressive. So I think we have to include China in any of these discussions.
All right. Never forget the 800-pound gorilla. Thank you, Timna and Phil.